Good day, everyone. In this presentation, our group will discuss the shareholders' equity case of Greenland Corporation, a stock corporation whose capital stock is divided into shares issued to investors. According to its articles of incorporation, Greenland Corporation has an authorized share capital of 2 million ordinary shares with a par value of 5. At the beginning of 2026, Greenland reported 3 million pesos in ordinary share capital, 850,000 pesos in share premium, and 4,500,000 pesos in retained earnings. Since the shares are ordinary, all shareholders have equal rights and privileges, with no shareholders enjoying preference over another. The main accounting and reporting issues in this case relate to proper measurement, classification, and presentation of shareholders' equity. First, issuance of new shares at different prices, which requires correct separation of par and excess over par. Second, cash and stock dividends, which must be based on issued and outstanding shares only, and treated as either small or large share dividends. Third, stock splits, which changes the number of shares and par value but does not change the total share capital. Fourth, acquisition and reissuance of treasury shares affecting retained earnings availability and requiring accurate tracking of treasury share cost. Lastly, appropriation of retained earnings for treasury shares, distinguishing appropriated or restricted from unappropriated or available for dividend distribution.
Now that the background and key issues have been discussed, we will now analyze the transactions for the year by presenting the journal entries and explaining the accounting treatment for each event. This transaction records issuance of ordinary shares for cash. Cash is debited to reflect inflow of funds received from shareholders. Share capital is credited at par value as required by accounting standards, while the excess of issue price over par value is credited to share premium. This ensures proper separation between legal capital and additional paid-in capital. For this next transaction, the declaration of cash dividend creates a legal obligation for the company to distribute earnings to shareholders. Retained earnings are reduced because dividends represent a distribution of accumulated profits. Dividends payable is recognized as liability upon declaration, not payment. Dividends are computed based on the total number of shares issued and outstanding on record date, ensuring equal payment per share. This transaction records another issuance of ordinary shares at above par value. Similar to the first entry, cash is debited for the proceeds received. Share capital is credited at par value, while the excess is credited to share premium. The declaration of a large stock dividend represents capitalization of retained earnings rather than distribution of assets. When declared, retained earnings decrease, while the share capital increases. Total assets remain unchanged, and only the components of shareholders' equity are affected. Since this is a 30% large share dividend, the amount charged to retained earnings is equal to par value of shares issued. A share split changes only the number of shares outstanding and the par value per share without affecting total share capital, retained earnings, or total equity. Because there is no transfer of value within equity, no journal entry is required. The transaction is disclosed through a memorandum note for informational purposes.
Next is dated on July 1, a 15% share dividend at 10 pesos. Since this is a 15% small share dividend, the amount charged to retained earnings is equal to the fair value of the shares on the declaration date. The share dividend payable account is recorded only to the extent of par value, and any excess is credited to share premium. Next transaction is dated on August 1, declaration of another 20-cent cash dividend. As with prior cash dividends, only issued and outstanding shares are considered in the computation. The payment on September 1 journal entry is also recorded by debiting dividend payable and crediting cash. The amount to be recorded is the same as the above entry. Next is on September 1, issuance of shares for legal services. Shares may be issued for services already rendered. They are recorded at the fair value of the shares received or the fair value of the shares issued, whichever is more reliable. In this case, since the fair value of the services provided, the transaction is measured at that amount. Share capital is credited at par value, and any excess is charged to share premium. Next is dated on September 30, the purchase of 50,000 treasury shares at 12 pesos. Treasury shares are the entity's own shares that have been issued and then reacquired but not cancelled. They are recorded at all these costs, regardless of whether they are acquired below or above par value. Next is on December 1, the sale of 30,000 treasury shares at 10 pesos. Treasury shares may be reissued or sold at cost, above cost or below cost, according to Pass 32. No gain or loss is recognized on the purchase, sale, issuance, or cancellation of equity instruments. Since the shares were sold below cost, the excess of the cost over the reissue price would normally be charged to share premium of the treasury. However, as there is no balance in that account, the difference is charged directly to retained earnings. And in the year end on December 31, under the trust fund doctrine, it is illegal to return legal capital to shareholders. To preserve the legal capital, the retained earnings must be appropriated at an amount equal to the cost of treasury shares. The appropriated portion cannot be declared as dividends until the treasury shares are subsequently reissued.
To wrap up our analysis, let's take a look at the final standing of Greenland Corporation's equity as of December 31, 2026. This period was marked by significant activity, including new share issuances, stock dividends, a 2-for-1 split, and treasury share transactions. By year-end, our total shareholders' equity stands at 8,669,410 pesos. Looking at the common stock and paid-in capital columns, you'll see the impact of our early year activity. We started with 3 million in ordinary shares. Through cash sales and issuing 10,000 shares for legal services, we increased our share capital. The most significant change came from stock dividends and a 2-for-1 stock split, which brought our total issued shares to 2,170,950 with a reduced par value of 2.50 pesos. Our share premium also grew substantially to 3,532,125 pesos, largely driven by the fair value of the stock dividends issued during the year. Moving to retained earnings, we began with 4,500,000 pesos but saw a heavy reduction due to over 3.8 million pesos in stock dividends and 550,590 pesos in cash dividends. Regarding treasury shares, we spent 600,000 pesos to buy back 50,000 shares. After issuing some at a loss, we are left with a 240,000 pesos debit balance in our treasury share account, which acts as a contra equity or reduction to the total. In summary, while our retained earnings decreased due to aggressive dividend distributions, our total contributed capital increased. This leaves Greenland Corporation with a strengthened equity base of 8.67 million pesos, fully compliant with Pass 32 reporting standards.
Based on our analysis, we recommend that Greenland Corporation continue using the memorandum method for share capital and the cost method for treasury shares, and keep detailed records of issued, outstanding, and treasury shares for accurate dividends. Classify retained earnings into appropriated for treasury shares and unappropriated for dividends. Record stock splits through memorandum entries, adjusting par value and share count, and disclose treasury shares in financial statements showing the number held and related restrictions. These practices ensure compliance, preserve legal capital, promote transparency, and support sound decision making. In conclusion, Greenland Corporation's 2026 equity transactions show how issuances, dividends, stock splits, and treasury shares shape shareholders' equity. Dividends and stock splits adjust equity without changing total assets. Treasury shares reduce retained earnings, and reissuances below cost follows Pass 32 with no gains or losses. Clear separation of appropriated and unappropriated earnings ensure responsible dividend declarations. The key takeaway: accurate and transparent accounting safeguards compliance, preserves legal capital, and strengthens shareholder confidence. That is all. Thank you for your attention.